Hi, I'm Ingrid and welcome back to my YouTube channel. Today we're going to talk about GameStop and what happened there and how it might change the course of investing forever. So as you've probably heard from the news, the subreddit wallstreetbets, which is a popular finance subreddit on Reddit, band together enough retail investing power to change the price of GameStop against the bets of major hedge funds. So in a way, wallstreetbets was able to make its own sort of hedge fund by crowdsourcing a bunch of retail investor power. So what is a hedge fund? A hedge fund is a fund with usually very high minimums to enter. So if you want to invest your money into a hedge fund, you have to meet a very certain high minimum bar of the amount that you're investing. And then the hedge fund trades on public markets. So it's a fund that trades stocks that are available to the public. So what's a retail investor? A retail investor is like your average person who's investing with like a brokerage app like Robinhood or Webull, or investing even through a financial advisor with Fidelity or Vanguard. What does it mean to artificially move a market? Hedge funds are able to artificially move markets because they manage so much capital. So if a hedge fund invests into a certain stock and they invest like billions of dollars, when they pull their money out, it can actually make the price of the stock go down, even though they're just one entity because they have so much money. That's referred to as price manipulation, which is something that hedge funds have been doing for ages with really no restrictions. So normally retail investors can kind of get slaughtered by hedge funds movements, and a lot of retail investors that are smart and trading in the market, they have to play to what the retail investors are going to do. Last week was maybe the first time in investing history that the retail investors actually outsmarted the hedge funds. So what exactly happened last week? Yes, it's complicated. It takes a minute to understand. So the first thing to understand is that several hedge funds, like Melvin Capital, decided that they were going to go short on the stock GameStop, GME. So what does it mean to go short exactly? Basically, taking a short position on a stock means that you borrow a stock from a broker. Let's say you borrow that stock at $3. Then you sell it to someone else on the market. Let's say you sell that stock for $3. Then you're hoping that the price of the stock will go down. Let's say maybe to $2, because then when you buy that stock back from the person you sold it to in order to return it to the broker, that's a $1 difference that you can then pocket. So it's a bet that the stock price will decrease in value. That's what going short or taking a short position on a stock is. So one thing that's important to note here is that when you take a short position or a long position on a stock, you actually risk losing more money than if you were to just buy that stock. Like for example, if you just bought a stock for $3, the most that you're going to lose is $3 if your stock depreciates to zero in value. But if you go short on a stock for $3 and you sell it to somebody and suddenly it goes up to $10, you could lose $7 in that transaction because you have to buy that stock back to return it to the broker. And now the difference between what you bought it for and the going price for that stock is $7. So you can lose an infinite amount of money, not just the money that you've invested. So with any short or long position, someone loses and somebody wins. So in this whole saga between the hedge funds and the Robinhood investors, the bag holder, the person caught holding the bag, was the hedge fund, where the Robinhood investors were holding the stocks that went up infinitely in value, and in order to return those stocks to the broker, the hedge funds had to pay the Robinhood investors the difference between what they bought GameStop for and what the Robinhood investors artificially pushed the price up to be. So number 3, some Reddit user, I think his name was like Roaring Kitten, he posted in the Reddit thread that he invested like $50,000 into GameStop and he thought the stock was actually going to increase in value. And one of the reasons why he thought that that might happen is because of something called a float. A float is a representation of how many shares are actually in the market in comparison to how many people have shorted that stock. And in the case of GameStop, there were actually less shares available on the market than people who had shorted the stock. It was one of the most shorted stocks on the market at the time that this all started happening. So in addition to the incredibly high float value, there are also some other reasons to be bullish about GameStop. It saw a 519% increase in online sales in the past year, and the billionaire founder of the dog company Chewy.com recently bought a 9% stake in the company. And also GameStop was negotiating some deals with Microsoft around online sales of its games. So there were some reasons why the company might actually go up in value. So given the incredibly high float and some of the bullish indicators about the stock itself, the retail investors in the Wall Street's bet thread basically realized if they bought the GameStop stock in droves, they could artificially drive up the price, and then all of the hedge funds that had shorted GameStop would have to pay them the difference between what they bought GameStop for and what GameStop ended up being because of the new demand in the market for the stock. So then, to add a little fuel to the fire, Elon Musk tweeted about the GameStop incident, and that drove the price up even more, and even more people started buying the stock. As this is all happening and hedge funds are losing billions of dollars to retail investors, a few important trading apps stopped allowing people to trade GameStop. They were TD Ameritrade, Charles Schwab, Webull, and Robinhood. So obviously this angered many people. They saw this as like terrible and corporate centralized manipulation of what is in theory a free market. In any case, a lot of retail investors did end up making a lot of money over their long positions. For example, Roaring Kitten, the original Reddit user with the $50,000, actually made $22 million in this whole process. And now Robinhood is actually getting sued by angry retail investors for disabling the buy button in what is supposed to be a free market. But let's dive behind the scenes and figure out what's actually going on. Is it Robinhood's fault, or is there more to it than we really understand? You see, Robinhood is just an interface. When you buy a stock on Robinhood, you're not actually buying that stock in the moment, even though the app tells you in the moment that you've bought that stock. What Robinhood does then is send your order behind the scenes to a market maker. And the market maker, usually I think Citadel is one of these big market makers, has to actually make you the purchaser of a stock, give that information to Robinhood to say, oh, like Ingrid purchased this stock, it's confirmed, and then Robinhood will send something back to you that says it's confirmed that you've purchased that stock. So who actually stopped the trading? Was it the fintech companies, which are essentially just operating platforms, or was it the market makers like Citadel, who were also poised to lose money with their relationship to these hedge funds? Lately, we've been hearing a lot in the news about decentralized finance, like Bitcoin, Ethereum, Litecoin, and all these other decentralized platforms for currency. This whole incident really makes a case for decentralized systems. That way, no one single market maker could stop something like this. A decentralized market would inherently be a free market, as no one entity would have control over the operations that take place in that market. So what's the takeaway here? We're seeing a big change in investor behavior due to mainly these new apps that are making investing more accessible, like Robinhood or Webull. Investor behavior is actually driving the market right now. For example, GameStop isn't worth what the price is showing right now. Like, as a company, its earnings just don't indicate that it's worth that much. The same could be said for Tesla, which I think is a great company, but in terms of earnings, it's not worth the droves of money that Robinhood investors are pouring into it. Looking at fundamental analysis or technical analysis, many of the stocks on the market aren't actually being correlated that well with the earnings and fundamental indicators of the companies that they're attached to. We're kind of seeing a similar thing with stocks and in the financial markets that we see with social media, where there are these meteoric rises of stars and then they can just plummet at any given moment. As more and more people get interested in investing, they invest in their idea of a company more than in the fundamentals or the economic validators of that company. Robinhood may be creating a whole new type of investor, not even a swing trader or a day trader, but an emotional investor that invests basically based on hype and what they're hearing in the news and what's going on in the market. This is a whole new type of investing that we've really never seen before now. It's a historic moment. So if you like this video, I hope you destroy the like button below and subscribe to my channel. Comment below if you have any ideas on videos that you want me to make or something that you want me to do more research on. In addition, if you're looking to learn to code, I do have an online course that teaches people how to code a portfolio website in JavaScript, HTML, and CSS. I'll link that below as well. Thank you for your time today. I hope that some of this made sense and you kind of understand what happened with GameStop a little bit better. So, peace.